1%, and it created another bubble. This time it was in real estate. And now they're doing exactly the same mistake. The question is, where will inflation spring up? In commodities, in real estate, in equities, in consumer prices, or in art prices? It can go anywhere. This is the difficulty in maneuvering through an inflationary environment. My view would be that essentially, if you just drop dollar bills onto the United States by helicopter, as Mr. Bernanke said, this they can't do, but they can electronically print money by the billions and trillions of dollars every day. That's not a problem. If you do that, then everything will go up, but some things will go up more than others. And my view would be that eventually gold will not be perceived as a commodity, but as a currency. Let's say you have $100 million or $1 million, and you want to be totally safe. You could argue, well, stocks are not attractive, so I go into cash, or I hold cash. But the problem with cash is that if you hold cash, it is an obligation of somebody else. Let's say you have money at the bank, then the bank owes you that money. What about if the bank fails? You don't get anything. So as an alternative to cash that pays essentially no interest at the present time, and I have to also emphasize the monetary policies of Mr. Bernanke and Mr. Greenspan have actually hurt the majority of people. The majority of people have actually cash deposits in banks. The retirees have cash deposits in banks that now pay no interest, or interest that are below the rate of inflation. So Mr. Bernanke and Mr. Greenspan have actually encouraged speculation, because if you get on your deposits in a bank less than the rate of inflation, then you ask yourself, well, what should I do? Then you go and buy homes, or you buy equities, and you speculate because you want to have a real return, which is not possible in real cash. And so, in my opinion, this negative real interest rate in cash deposits will, in the end, lead people to think, well, in this case, I rather own a sound currency where the supply cannot be increased, which is essentially gold. You can increase the supply of paper money endlessly, but you cannot increase the supply of gold endlessly. So I think that every individual has to think that the government is utterly dishonest. Basically, they're a bunch of crooks. They don't look after the interests of the people. They look after the interests of the elite, whoever that may be, but it sits mostly in Wall Street. And the ordinary people have been hurt by the monetary policies of the United States. That's why they pay high oil prices, they pay high food prices, and so forth and so on. And that's why they had also declining home prices lately. Now, I would suggest an individual should have some of his money in gold, and although I don't think that stocks will enter a new bull market anytime soon, we could have a rebound in stocks, and also what might support equity prices. Again, if you put your money in the bank and the bank doesn't pay you, you've lost everything. Or if you had your money at Lehman or in Lehman bonds, you lost 90% or more. But if you own shares, maybe the shares will go down 50% or 40% or 30%, who knows. But you're still a shareholder. So there is actually some kind of safety in owning top-quality companies vis-a-vis owning deposits in the banking system.
Well, Wall Street has suggested buying all the way down. They would still argue that these markets are cheap. Now, I don't know what that is relative to, but they would argue that these are inexpensive markets. Would you view most of your analysts on Wall Street as just being in a state of denial? The recommendation has been for 6 months to be buying the financials, which has been the leader on the downside. Surely it won't be the leader on the upside.
I mean, my view is that most analysts have no idea. I went to a seminar, I think it was in 1999, and there were 3 leading strategists, and I suggested to buy some gold. And all the analysts and strategists said, well, it has no value, it's only been going down for 20 years, and you have to be positioned in NASDAQ and so forth and so on. I'd also like to remind your listeners that when the NASDAQ bubble burst in March 2000, the oil price had actually already increased from $10 to $25. and went to $30 in 2001, when the whole investment community was still recommending to buy NASDAQ stocks. I mean, I'm very disappointed by the lack of imagination and understanding of market movements by the investment community. And I would say that today analysts are far too optimistic. The consensus estimate for the S&P for next year is $100. I can assure you the S&P will not earn $100 next year. This is Alice in Wonderland projection. If the S&P earns something like $70, they'll be lucky. And on that basis, the market is simply not cheap. I also have figures or graphics of the stock market in real terms, inflation adjusted. Inflation adjusted stocks are still near their highs. They're not cheap at all. They were very cheap in 1982 because in 1982 the Dow Jones was at 800, where it had been in 1964, 18 years earlier. Bear markets can occur in different ways. They can occur in nominal terms or in real terms. In nominal terms, I give you an example. The Nikkei was at 39,000 in 1989. It's now around 12,000. And this is almost 19 years later. So that stocks always go up and that they are cheap is totally a total misconception. Stocks are actually very expensive still. Now, I'm conceding that compared to interest rates that are at zero, stocks are not particularly expensive. But I think that eventually these monetary and fiscal policies by the United States will lead to higher interest rates. And I'd just like to remind you that since the bailout plan was announced, bond prices have been going down. So I think that everything considered, equities are not inexpensive. They're not expensive if you look at the last 12 months' earnings. There is no valuation bubble the way we had it in the high-tech sector in year 2000 or in Japan in 89. But we have an earnings bubble, and this earnings bubble has to be deflated. And I think it will happen very badly. And therefore, stocks that appear to be today relatively cheap may not be very cheap in a year's time simply because the earnings will have collapsed. Dry ship sells now at 2 times earnings. Now, is it cheap or not? Well, the Baltic Dry Index has dropped something like 70% in the last 6 months. The earnings are obviously going to go down, and suddenly this company will sell at maybe 20 times earnings or maybe endless earnings because they will have lost.
You're listening to the McAlvany Weekly Commentary at McAlvany.com. That's McAlvany.com.
Well, if you look at 1932, 1948, 1982, some of the classic bear market bottoms, that the valuations of stocks, both in price-earnings terms and in dividend yields, were very different than today's landscape and would argue for...
Yeah, sure. In the 1940s, stocks had a dividend yield of around 7%, the Dow Jones, and Treasury bonds were yielding 2.5%. In 1982, stocks had a PE of 7 times earnings, but depressed earnings because we were in a recession. We haven't even started the recession yet, but I can guarantee you, if you have an economy that is credit-driven, and we had huge credit growth in the period 2000 to 2007, when credit was expanding at 5 times the rate of nominal GDP. Once credit growth slows down, a recession is inevitable. And I think we're going to have a bad recession in the world. What is unclear to me is this recession going to be deflationary and all asset prices collapse, from paintings to Damien Hirst art to equities to real estate to commodities, or is this recession going to be inflationary? In other words, you have high inflation in the world, but people suffer from declining real income. That can also happen.